If you checked your 401k or brokerage account today, you might have felt a jolt of concern. The numbers on your screen probably looked a little less friendly than yesterday, and you're not alone in noticing it. You probably noticed a dip, a sudden drop that can make even seasoned investors pause and wonder what's going on. The stock market took a step back today. It wasn't a dramatic crash, but it was enough to send a ripple of anxiety through Wall Street and Main Street alike, a clear sign that investors are feeling uneasy. The Dow fell about 200 points, the S&P 500 dropped 0.2%, and the Nasdaq slipped 0.3%. These numbers might seem small, but they represent billions of dollars in value and reflect the mood of the market. These numbers reflect widespread caution, not panic. Investors are taking a step back, reassessing their positions, and trying to make sense of the latest headlines. Investors are weighing mixed signals: global trade tensions, questions about economic health, and the impact of rising costs. Every headline, every economic report adds another layer of uncertainty. When uncertainty rises, investors often sell first and ask questions later. It's a natural reaction, but it can lead to overreactions and missed opportunities. That's why it's crucial not to react emotionally to days like this. Taking a deep breath and reviewing your long-term goals can help you avoid costly mistakes. One red day doesn't define your long-term investment strategy. Markets have always had ups and downs, and history shows that patience is often rewarded. Instead, use it as a learning opportunity. Take time to understand what's driving the market and how it fits into your personal financial plan. Global politics and economic reports directly impact your money. From trade agreements to interest rate changes, these forces shape the market's direction. Understanding these forces is the first step to becoming a smarter investor. The more you know, the better prepared you'll be to navigate volatility. Pay attention to these signals, not to panic, but to prepare. Use them to inform your decisions, not to drive you to rash action. The market's daily moves are signals, not verdicts. They're part of a much bigger story that unfolds over months and years. Stay focused on the bigger picture, keep learning, and remember, successful investing is a marathon, not a sprint. The main reason for today's market jitters: tariffs. A tariff is a tax on imported goods. Right now, the US and China are locked in a trade war, taxing each other's products. This makes everything from electronics to furniture more expensive for businesses and consumers. The uncertainty from this trade war clouds the global economy. Companies can't plan ahead, and investors hate unpredictability. The US has a 30% tariff on many Chinese imports. China has a 10% tariff on US goods. That means higher costs for companies, lower profits, or higher prices for you. Every rumor about US-China trade sends ripples through Wall Street. Investors crave a stable, long-term deal to end this cycle of tension. Until then, the tariff saga dominates the market's mood. It's the main character in today's financial story. Today's specific news: it's a headline that's been echoing across financial networks and newsrooms all day. President Trump has announced a 90-day extension before new tariffs on Chinese goods are set to take effect. This move temporarily pauses the escalation of the ongoing trade dispute between the United States and China, giving both sides a little more breathing room. On the surface, a delay like this might sound like a relief, an opportunity for negotiations to continue. But the market's reaction was far from celebratory. The extension pushes the tariff deadline out to November 9, 2025. While that date may seem distant, it's a clear signal that a comprehensive deal is nowhere in sight, and the uncertainty is far from over. It's a bit like postponing a tough conversation with a colleague. You might avoid immediate conflict, but the underlying issues remain unresolved and continue to weigh on everyone involved. Investors were hoping for a breakthrough, a sign that the trade war might finally be winding down. Instead, they got another delay, and with it, more questions than answers. This ongoing pattern of extensions and delays is wearing down the market's patience. Each new deadline brings a fresh wave of anxiety and speculation. Wall Street craves stability and predictability, not a series of rolling deadlines that keep everyone guessing about what comes next. For businesses and investors, this extension means at least another quarter of uncertainty. Strategic decisions are put on hold, and long-term planning becomes nearly impossible. The market's sell-off wasn't just about the extension itself, it was about the lack of a real lasting resolution. Investors are growing weary of temporary fixes. Once again, the can has been kicked down the road. the core issues remain, looming larger with each passing deadline. Investors are left in limbo, waiting for genuine progress and a clear path forward. The uncertainty is palpable in boardrooms and trading floors alike. The cycle of hope and disappointment continues, with each new headline sending markets on a roller coaster of emotions. In this environment, uncertainty is the only constant. Until a real agreement is reached, markets and investors will remain on edge, bracing for whatever comes next. Let's zoom in on the semiconductor sector, one of the most fiercely competitive and geopolitically sensitive industries in the world. Semiconductors are the backbone of modern technology, powering everything from smartphones and laptops to data centers and artificial intelligence. The companies that design and manufacture these chips hold enormous influence, not just in business, but in global politics. Recently, Nvidia and AMD struck a unique and controversial deal with the U.S. government, one that could reshape the landscape for years to come. Under this agreement, both companies are allowed to resume selling certain types of chips to China, a market that represents billions in potential revenue. But there's a catch. The U.S. government will take a 15% cut of all revenue generated from these sales, essentially acting as a gatekeeper and stakeholder in the process. This arrangement is unprecedented. On one hand, it opens the door to a massive market that was previously restricted. On the other, it comes at a steep price, both financially and strategically, as companies must now share a significant portion of their earnings with the government. Importantly, the deal only covers older chip models, not Nvidia's or AMD's latest, most advanced technology. This limitation is a direct response to national security concerns, as cutting-edge chips are seen as critical assets in the race for technological supremacy. The U.S. government is trying to strike a delicate balance, supporting American business interests while also safeguarding sensitive technology from potential adversaries. For Nvidia and AMD, this is a tough trade-off. They gain access to a lucrative market, but their profits are squeezed by the government's share, and they risk falling behind in innovation if they can't sell their best products. Investors are left wondering whether this deal is a win or a loss. The uncertainty is reflected in the market's cautious reaction. Both Nvidia and AMD stocks finished slightly down as the market digested the implications of this new arrangement, signaling investor hesitation. The deal adds yet another layer of complexity to an already tense and rapidly evolving sector, where every decision can have global repercussions. It's a vivid example of how global politics and international relations are now deeply intertwined with business decisions in the tech world. Companies like Nvidia and AMD must now navigate not just fierce competition, but also the shifting tides of geopolitics and regulatory oversight. The semiconductor story is about more than just chips. It's about power, influence, and the future of technology itself. This deal marks a new chapter in that ongoing story, one that will be closely watched by governments, businesses, and investors around the world. As the dust settles, the market is watching every move, knowing that the next decision could reshape the industry's future. Beyond tariffs, inflation is the next big concern. The Consumer Price Index (CPI) report for July is about to drop, and everyone's watching. CPI measures how much prices for everyday goods and services are rising. Economists expect a 2.8% annual increase, faster than last month. Why does this matter? The Federal Reserve uses inflation data to decide on interest rates. If inflation is high, the Fed may raise rates, making borrowing more expensive and stocks less attractive. A hot CPI report could spook the market, a cool one could boost it. The Fed's next move hinges on this data. Investors are on edge, waiting for the signal. The CPI report is the market's next big test. Tariff and inflation news ripple through all kinds of investments, not just stocks. Gold, oil, and Bitcoin each react differently to economic shocks. When fear rises, investors often flock to gold as a safe haven. Oil prices reflect expectations about global growth. Trade wars can push them down. Bitcoin is the wild card. Some see it as digital gold, others as a risky bet. Its reaction to news is unpredictable, but it's increasingly part of the conversation. Watching these assets helps you understand the market's mood. Diversification is key to weathering volatility. Each asset tells a different story about fear, confidence, and opportunity. The interplay between them paints the full financial picture. Despite market turmoil, gold prices actually fell sharply today, down over 2%. Why? Last week, rumors swirled that new tariffs might include gold, sending prices soaring. Today, the administration clarified, gold won't be taxed. The rumor-driven buying frenzy ended and traders rushed to sell. The price spike evaporated as quickly as it appeared. This is a lesson in how rumors and clarifications can move markets. Gold is usually a safe haven, but it's not immune to wild swings. Today's drop was about a specific rumor, not general economic fear. Markets react to both facts and speculation. Always look for the real story behind the numbers. While gold fell, oil and Bitcoin moved in opposite directions. Oil prices dropped nearly 3% to $67 a barrel, signaling fears of a global slowdown. Trade tensions threatened China's manufacturing, reducing energy demand. The tariff extension reinforced worries about weaker growth. Meanwhile, Bitcoin surged, briefly hitting $122,000. Strong demand for Bitcoin ETFs and expectations of Fed rate cuts fueled the rally. Lower rates make cash less attractive, pushing investors toward alternatives like Bitcoin. For many, Bitcoin is becoming digital gold, a hedge against inflation and currency risk. Oil and Bitcoin's moves show how different assets respond to the same news. Each tells a unique story about the economy's direction. The divergence highlights shifting investor priorities. The market is searching for safe ground. To sum up, today's market drop was about disappointment, not disaster. The 90-day tariff delay signaled more uncertainty, not resolution. Tech companies like Nvidia and AMD face new challenges from government deals. All eyes are now on the upcoming inflation report. The Fed's next move will shape the market's direction. Investing is a long-term journey through unpredictable waters. Don't panic. Understand the forces at play. Knowledge is your best defense against volatility. Stay informed, stay diversified, and keep your focus on the big picture. The market's daily swings are just noise. Your financial power comes from understanding, not reacting.